Hello, everyone. I'm Rita Garwood, Editor-in-Chief of Monitor, and I'm excited to welcome you to today's live stream. Today's panel of experts are going to discuss the operational complexities of portfolio transactions in the equipment finance market. And as a participant today, you will learn how to navigate data tapes, vaulting requirements, and resource protections to bridge the buyer-seller trust gap and ensure deal profitability. We are pleased to partner with NorthTech on today's live stream. NorthTech is a Minneapolis-based fintech provider that delivers automated lending solutions to more than 10,000 equipment finance users. Their Aurora platform helps lenders make smarter, faster origination decisions and covers the full deal lifecycle. NorthTech also partners with industry leaders like Middesk, Plaid, DocuSign, and T-Value, and is backed by Arthur Ventures, an early growth capital firm. Visit northtech.com to learn more. Our panelists are eager to address your questions today. Please use the Q&A button on your Zoom panel to submit your questions at any time during today's event. You don't need to wait until the end. Our moderator, Christian, will be keeping an eye on that and will bring up your questions as they come up. And finally, it's my pleasure to introduce you to today's panel. Leading our discussion as a moderator is Christian Dolan. Christian is CEO and founder of NorthTech. He brings more than 18 years of origination expertise to today's discussion. And on our panel of experts, we have Chris Maudlin, CLFP. Chris is Chief Operating Officer of Wintrust Specialty Finance. Chris held roles in credit, funding, and risk throughout his 20-plus year career before becoming a COO 5 years ago. Also joining us today is Chris Morrell, CLFP. He is SVP of Capital Services at FinWise Bank and brings 15 years of equipment finance experience to today's discussion. Next up, we have Jordan Segusa, a business consultant at Suru Consulting, where he helps equipment finance companies improve their operating environments and enhance the customer experience and drive innovation throughout the lending lifecycle. And last, but definitely not least, we have David Trost. David is Director of Product at NorthTech, and he has over a decade of experience building innovative fintech solutions across lending, risk management, and analytics. And David is also one of Monitor's 2026 Next Gen leaders, so keep an eye out for his profile when that comes out in June. And with that out of the way, I will hand it over to you, Christian. Thanks, everyone.
Great. Well, thank you so much. I guess I'll start by thanking the Monitor. You guys have an amazing team. Laura, Rita, you've been great to work with, and thank you, Lisa, as well. And second, thanks to our panelists. I know all of you guys a long time and really appreciate taking time out of your very busy schedule to join us. So really appreciate that. So, well, why are we here today? What are we talking about? Obviously, portfolio purchases and sales, and that's why you guys are all here. But why does it matter? I think what is really unique about this in our industry is it's an extremely powerful lever. If you're an independent, obviously selling portfolios allow you to free up capital, create more originations. If you're an independent, you're buying portfolios that we're seeing more and more of nowadays. You're able to put capital investment to use and ramp up your portfolio quickly. On the bank side, we're seeing more banks selling portfolios. They're doing it for diversification, exposures, risks, and whatnot. We saw it a lot a couple years ago with just like increasing liquidity. And if you're a public bank nowadays, sometimes you just need some fee income to make some numbers. And it's a great tool on the sell side for that. And then on the buy side, it's just a great way to just increase spreads, right? Like get good returns from these portfolio purchases. And then, of course, there's the captives. And, at the end of the day, they really want to just help sell more equipment and working with capital partners to sell portfolios so they can continue to help their parent company do that is an essential tool. So this should be a fun discussion. It's really with some very seasoned professionals here. We're going to talk about how to buy portfolios, how to sell portfolios, and where do things break down. So with that said, we're gonna get started with the first question. So So I'll start with Chris Monlin. So Chris, seems like a lot has changed in the last 2 to 3 years as far as like portfolio activity. What's your thoughts on that? Like, why are we seeing that?
Yeah, thanks, Christian. I think what we're seeing a lot of is really a change in really the marketplace and really the sophistication of, I'd say, the end user to start with, and really looking for speed to decision and speed to funding and getting their equipment, which is what they're coming to us for. And so with that kind of requires all of the originators out there really to improve their game and really get more sophisticated on their side, whether that's getting lines of credit or being able to hold transactions. And the reason is it's really you want to control that customer experience, right? You want to be able to take them from credit application through to funding in a much more smooth and streamlined process versus needing to send that out to a funding partner. And so with that comes the portfolio sales, right? Where portfolios become much more efficient on the back end of the process. From a front end to the customer, there's really no friction for them. You're able to manage the process from application through to equipment delivery and funding and really manage your spread, manage your pricing on the back end. And so that's one of the things we've seen a lot of the last few years. With that comes a lot more, money getting into the market, chasing these transactions, getting, looking for more of the portfolio sales because it does open up more, I would say, buyers as well. So if you're looking to sell portfolios, when you're selling a one-off transaction, your pool might be more limited, but when you start to look at syndications and larger pools, it starts to open up the market a little bit more. But that's one of the big things we've seen over the past few years.
Yeah, that's a great point. I mean, just having control of that customer experience, not having kind of that disjointed broker experience where you're passing it off to a lender, having to wait for them to underwrite, come back, maybe generate contracts on their docs. You can kind of control that all the way past funding and then kind of reload
Yeah.
your capital
For
afterwards.
sure. And I think one of the things that we talk about quite a bit is all of us on this call are consumers at the end of the day, right? And we're used to, buying things on our phone, quick decisions. And so the, the profile that end user who is actually your equipment buyer and, might be a C-suite person on the other side of the documents, but their expectations are starting to change with technology. And so that drives this in our market as well.
Yeah, great. Well, kind of shifting gears a little bit, I guess. So, Chris Morel, are you like you've been in the industry, I think 18 years? Is that what Rita said? So, like, uh, something like
Team.
that. Are you seeing different types of sellers entering the market?
Yeah, it's it's been a unique ride for me. When we started the group 5 years ago, um, it was all we did was just buy discounted cash flows. But over the past 5 years, I've seen, a lot of the friends that were, former sales reps starting new, single man brokers and growing those businesses to, multi salesperson originators and, kind of just evolving with the time. So it's definitely been a progression for us, right? Just like the Chris mentioned earlier with the consumer evolution of expectations and processes and all that, we've seen a huge leap in the sophistication of folks that were once just getting started to, now running, huge origination channels. So it's been a nice thing to watch when you see, I think everyone in the industry is pretty friendly. And when you see people evolve and grow and mature, it's a nice thing to be able to be a part of.
Yeah, that is cool to be part of, especially if you've worked with them before and you can kind of see them grow. Do you guys think, I mean, it's kind of open to everyone. Do you think the number of originators that are selling portfolios has increased with that said, or have they been consolidating, cycling? What have you guys seen there?
Um, I would say that there's been, a large number of people that uh, have, you know, reached out over the past 12 months, 24 months that are, wanting to, churn their capital a little bit more than they once had. You used to have people selling 25 to 30% of their originations. Now, some partners are selling, more than 50, more than 60%. So I think the word is out. I think CECL has a lot to do with it. I think people want that fee income more than ever now. A lot of banks are pretty well loaned up. So, we're seeing more activity from banks, whereas, 2 or 3 years ago, banks were loading up on loans. So it's been an interesting 24 months.
Yeah. So
I would add something, just backing up even further on a broader scale, Christian, and I'll admit I'm probably the old guy in the crowd. I've been doing this since 1999, and a lot has changed in those almost 30 years, right? Whereas banks are a lot more comfortable now lending money to independent lessors than they were 25 years ago, because the industry has become a lot more prevalent. More and more banks have gotten into the industry, and a lot of subgroups have started that focus on financing those warehouse lines or temporary lines for the independents so they can portfolio warehouse and sell them off. So I think the prevalency of this business has gotten to a point where it's a lot more prevalent to see portfolios because there's more capital available for the lenders, the lessors to use.
Mhm.
Yeah, and I'll jump in there too. Jordan's making great points. I think what you see is, I would almost put it as a tale of two ends, right? So on the front end, kind of the large banks, independents, what you're seeing, you mentioned it before, really exposure sales. And as companies get acquired or banks acquire, or they need a liquidity, you're getting more banks that are comfortable with selling off portfolios, right? And the primary factor for them is, again, customer facing. They want to maintain that look and feel. So you get a lot of, the blind syndication where everything's private label under the original seller's label. But on the other end of the spectrum, to Christian's point, you've got more financial institutions that are willing to put lines out for independents, which then is fueling kind of that front end sale where they might not have been able to previously compete with captives out there, but now that they've got a line, they're able to actually start to do that, start to book and sell wholesale. So I look at it as kind of the tale of the barbell in some ways. Both sides, I see kind of an increase in those sales.
Yeah. I don't think either of you guys mentioned the private equity, private capital entry into the industry. Have you seen like the significant change from in the last 5 years as far as that front goes? The type of people that either are putting equity investments in the independents or on the buying side, or
I've seen a few. I mean, I've seen some of the other commercial products, like some of the bigger folks in the commercial working capital space, towing water on equipment finance. I do think the word is out. It's become a much more household name proverbially in terms of equipment finance is another way for folks to deploy the capital. And, private equity is seemingly everywhere from roofing to equipment finance. So it's definitely been busy in that space.
yeah. Got a comment from Mark Bellick, who I go way back with, and he mentioned he's seeing a lot more private investors are becoming a lot more prevalent. So thanks for that, Mark. Hey, David, from a technology standpoint, have you seen any shift in how things are being done in like the last 2 to 3 years?
I think when it comes to validating the tape, which we'll talk about in a minute, there's been some shifts there. I think in general, it's a lot easier to do risk-based pricing now, and it's a lot easier to process individual contracts in volume with functionalities available in most LOS systems today. So processing large portfolios and underwriting at an individual deal level, instead of just looking at it as a whole portfolio asset at once, is becoming more prevalent. And then how information is transferred between lenders has also changed. So it's easier to create APIs now than it ever was before, and maintaining them is lower infrastructure cost than it ever has before. So being able to facilitate the transfer of deal data, at least at an individual level. I know there's a couple lenders that do it on a portfolio level, but providing one-off deals through an indirect channel to buyers is becoming more common.
Yeah. Yeah. Okay. So like just so being able to underwrite each deal individually automatically, has, having the tools to do that, plus just transferring, getting in some cases getting away from data tapes and using APIs.
Yep.
Okay. Well, cool. Well, let's kind of jump. Actually, Laura, if you don't mind, would love to see the poll. Great. If you guys get a chance, could you just spend a little time and answer the poll questions here, and we'll kind of circle back with the panel when we get a chance here. And I've got a question from Sherry Williams. Hi, Sherry. Thanks for the question. It's how are most leveraging AI to score and adjudicate portfolio acquisitions? I don't know, Jordan, with any of your clients or David, you could speak to this. But how are lenders using AI to score and adjudicate portfolio acquisitions?
I don't know if I have a specific example, Christian, that I can share, but what I've seen just as far as AI's capabilities in the industry is starting to blow my mind. I've really just started to scratch the surface on it. But if you just think about what the activity involves when you're scrubbing a portfolio or doing an evaluation, you've got lots of lines of data, lots of rows of data, and it takes a person a lot of time to do that. With artificial intelligence, the tasks, if you're looking for common characteristics or outliers, it can be done in a matter of seconds. I know it's a very generic statement, but I really can see a lot of time savings that can occur even with the most simple non-trained models.
Yeah, I agree. I think when it comes to scrubbing the data, it used to be well, it still is for the most part. You ask for a template for your data tape as a buyer to the seller. You hope that they can fill it out correctly and get it back to you in a format that's easy to scrub and work with. So where we talk about standardization in general of like we hope the industry gets to a point of having the same data tape for every buyer. I think AI is making that kind of unnecessary because you can just say, given whatever output I have from a seller, how do I go and pull the data points that I need to underwrite or identify gaps, like Jordan said, and get 99% of the way there. So you're asking for less data up front, and it's easier to scrub and deal with what you get.
I think a lot of that goes to the organization's AI tolerance. And so I know, from a banking standpoint, we're a little bit slower because we need to do things much more cautiously given sensitivity and data, like making sure we know where the data is going to rest and making sure we have proper procedures and controls there. That being said, I think, there's lots of tools that are, AI-esque, whether it's bots or automations that you're able to put into your process to cut down as much manual work as possible. I would say on more the PE side, you probably might see more leveraging of AI and those tools, especially those that aren't familiar with the industry. It can help facilitate and kind of speed up their understanding of what they're looking at there.
Yeah. Well, nowadays, it's got to be part of the solution, right? It's coming. So, all right. So kind of on that same lines, kind of back on the data tape. So David, you talked about, some of the challenges with getting and standardizing the data tape. Can you speak a little bit more about that?
Yeah, so the typical process we see is a buyer will provide a template tape to a seller. The seller will have to go and fill that tape out and send it back to the buyer. So origination quality from the seller really drives how good that tape is up front. So a lot of the onus is on them to make sure that they're collecting the NAICS codes if that's what's needed. The guarantor records are all filled out. Equipment descriptions and free text fields are structured in a way that can be understood by the buyer. And whatever the seller didn't enforce at booking now becomes the buyer's problem when they get the tape and have to do due diligence. The other challenge is the format of the tape. So you're taking something that is a lot of different tables in a loan origination system and a servicing system and trying to make that flat and putting it in one Excel sheet. So if you don't have scripts in place to do that or a data team to work with and you're a smaller shop, that often comes down to just like straight up copy and paste. And you hope that the format gets preserved when you put it into the Excel spreadsheet. And so like with the conversation was going earlier about how LLMs can help deal with mapping data and validating it, it applies to the seller too. So when we were selling portfolios at a lender that I previously worked at, I was the one who would have to go and write all these scripts and deal with the data extracts. And so it took some technical knowledge. And so that barrier is way lower now. So you don't have to have an LLM baked into your process. You can say, here's what I want this thing to output. Here is all the different formats that I'm able to export from my system. Write me a script that does the same thing every single time to produce this fancy Excel sheet that I can send to whatever buyer that I'm working with. And then on the flip side, I mean, we kind of already hit this where it's the reverse of that of saying, okay, I have this information that I now receive from a seller. I need to get it into my system. Help me format this in a way that I can go and do that and make sure that it's the same every single time. So you're using the LLM to help build the infrastructure instead of having it interpret the data that you get every single time and potentially, hallucinate or get slightly variable results.
Great, thank you. So Chris, you guys are very progressive as a bank. What sort of technologies are you kind of putting in place, or what do you guys have in place nowadays?
To be more specific, is it East or West Coast?
Oh, I'm sorry, Chris Morrell. Yeah.
Well, I think we're a big believer in the North Tech system, and so that is my plug for you, Christian. I hope that you remember that next time I send you a request. But we are primarily a fintech bank, right? We do a lot of that fintech lending, banking as a service, cards, payments, all that stuff, and so it's natural progression. Call it osmosis for us to be more technology focused on our originations. We have a small team of 8 people. So we like to, utilize and pick up any efficiencies that we can through the use of technology. So, we definitely kind of can be a little bit too careful at times, right? I'm sure if you talk to some of our originators, some of our partners, they would be a little bit frustrated with how thorough we are. But any of the standard reports that everyone uses, we're utilizing as well. We do kind of go a little bit deeper with some of the other plugins that you offer. And so from time to time, we'll find stuff that the originators, maybe missed or just didn't show up on their version of the payment report that they have. A bankruptcy from 20 years ago on Clear, you name it. I think that's one of the biggest hurdles with our business is that, we are very thorough. We do adjudicate each deal. And so it's definitely a double-edged sword.
Yeah. And I guess that's where the technology is key, right? Where David was going. If you're going to be at that thorough, making sure you've got APIs to call those things can happen automatically is important. So, all right.
I could jump in real quick, Christian,
Yeah.
on a couple of notes there real quick. So in terms of the standardizing of the data tape, I'll speak to an experience we had prior to joining Wintrust at another organization where we had our template and we were really trying to force all of our portfolio sellers to get on our template. And again, this goes to the barbell concept, right? The newer portfolio sellers, they were more open to acquiescing and putting their data on our template. As you move up market and you're starting to deal with the more sophisticated sellers, they're not going to put it on your template. And so it was trying to work and get that on our template, which then meant somebody in our team was typically VLOOKUPing data or, heaven forbid, copying and pasting, right? And so you start to open up these challenges for data integrity that starts to pop up there. And so, one of the biggest things I think is, for us still to this day, right? We have a template, but our template's twofold. One, we have a standardized template that, hey, if somebody doesn't have one, here's what we would love to see. But primarily it's more field-based, right? And here's the data points that we're going to need. And to David's point, what you're typically getting is you're getting information from a front-end system and a back-end system. And we're asking as the buyers, hey, flatten it, put it on a single data tape, single tab. The more sophisticated buyers they're giving you multiple tabs. And we experienced this when we actually sold a portfolio. After all these years of trying to force people onto our template, now we've got to put one together. And my gosh, it was miserable, right? And so I totally understand from that. That was the eyeball, light going on for us is, okay, we need to be more flexible because we need to understand that depending on who you're working with, they may or may not be able to get that information on there. And that kind of feeds into that next part, data quality. If you think about the data quality that as a buyer, what you're getting, right, you're really dependent on where that data is coming from. And most sellers, the front end data is probably sales input or customer input, right? And so there's not necessarily a single source of data and there's not a consistent entry there. And so, whether it's NAICS codes, whether it's collateral descriptions, right? There's not a real standardized format that's coming over there. So, what you run into is a lot of inconsistencies there. And going back to Sherry's question, right? Where can AI help? Like that's an area I think that AI can definitely be beneficial is helping to give a more consistent singular view, kind of whether it's right or wrong, right? At least you're getting consistency in your data. And so I think that's definitely one thing if you're selling portfolios or looking to sell portfolios, you really should take a look at what your data entry components are, what your data validation standards are, because if you're able to provide better data, guess what? That makes you more intriguing to a buyer, right? We want to work with you, right? And that helps out across the board because again, when you're selling portfolios, you're typically repping and warranting the data that's coming over because that's what we, the buyers, are typically using as a foundation piece for our decisions. And so it's really important that you've got your data tight, you've got your data clean, because heaven forbid something that you represented on that data tape turns out to be inaccurate and misleading, right? That's probably going to be a buyback situation because it was a material type of data point there. So I think the big thing there from a data point standpoint, from a seller side, right? Try to make sure your data is clean, right? And try to get it into a consistent format. To David's point, if you're able to, buy a tool, bring a tool in that helps you merge the data from these two disparate systems, the back end and the front end, wonderful, right? Because at the end of the day, we don't want multiple files. We can deal with multiple tabs, right? So obviously front end and back end information. And then from a buyer standpoint, right, making sure that you're trying to be as flexible as you can, depending on who your client base is, right? If you're buying from smaller originators, you can probably get your table and your data tape filled out the same way every time. But as you start to move up market, you got to bring some flexibility there as well.
Yeah. Well, lots there, Chris. I mean, I think your point about, striking that balance between, the sales, the upfront, the originators trying to get the deal approved, trying to get a doc signed and whatnot. But there's so much more to it than that. You got to look beyond that and get enough data. Obviously, you have to strike a balance there, but get enough data that it's quality content that you can get, that you can sell off. On the like from your guys' standpoint, like what are like some of those key data points? What are examples of the key data points that you require? Like when you go to the funding conference, Chris, when you talk to a new originator, what are the things that you tell them that you guys require in order to underwrite a deal? Like, sorry, that's Chris Modlin, like back at you.
No, perfect. Yeah, so our range of data points are, I go back to my credit days, really, right? you need to know who your obligor is. You need to know all the guarantors, obviously addresses, the PII information, personally identifiable information for those that aren't in the banking world that have to deal with this all the time. So, um, obviously tax IDs are a big component of that too, making sure you've got tax IDs for the obligor, equipment descriptions. For us, we like to see the credit scores that you pulled. And primarily we don't adjudicate based off that, but it helps us in our conversation with the partner. So if we're running a different credit or seeing a different credit score, we like to actually make sure that, if we're not connecting, we actually are seeing what you had and we're telling you why we're missing. Nick Gibbons, one of our great reps out there, message saying NAICS codes. NAICS codes are a big part of it for us. And, some organizations have SIC codes and are using SIC codes, but in that case, there's bridges you just need to kind of work through and translate. And then obviously on the back end, what you're looking for is all the pertinent information, right? So you need your payment streams, you need the specific payment timings, and depending on what back end accounting system you're using, the way that data comes out of the system could be a little challenging. It could come out as a row versus a column. And so making sure you're getting the cash flows spit out properly and timely, understanding what the original finance amount was, last payment, next payment due, any delinquency that's happened. Because again, you want to make sure from a disclosure standpoint, you're meeting all your reps and warrants from a disclosure. And obviously, if you're selling a non-performing loan that defaults within the first month or two, not only do you jeopardize that relationship on that transaction or having to buy it back, but you might jeopardize that relationship as a whole. So the data integrity is a big part there.
Yeah, that's a great point. I don't know, Jordan, like with all your clients, I mean, that was a lot, right? Like there's a lot of, there's scores and NAICS and collateral descriptions and things like that, and portfolio performance data. What are some of the challenges there that you're seeing with in your past life as a lender and then now with some of your clients?
A lot of what Chris said, a lot of it is systemic or what system you're using. And unfortunately, there's not been a huge amount of innovation in lease accounting systems. And there's a lot of people still on legacy systems where you have very limited options as far as how you can access the data. For most small shops, for a bigger organization, they can tap into the data warehouse, they can manipulate it using, BI tools, so on and so forth. But I'd say your average lessor is going to use the built-in reports or crystal reports, and it's just messy, right? So that's probably the biggest, it is the data formatting and getting access to the data.
Yeah, yeah. And like David was saying, hopefully that becomes easier now. So we got a question that came in from Sherry again. So and either Chris Morrell or Chris Monley can jump in here, but like so who who typically pays for the updated pulls? Like, so if the buyer's going to pull another PayNet, pull another consumer credit bureau on the bureaus, who takes on the cost for that? Typically,
The short answer that I can give is we do, right? It's all baked into the economics of the discount rate that we can offer to the seller.
okay.
Yeah, we're the same. I mean, it's, we're doing additional due diligence, and so those are going to be typically data feeds that we have. So we're pulling those. It's not something that we net out of a sale price. It's just part of our due diligence.
Got it. And I kind of reread her question a little bit. I guess, is it common for a buyer to request that the seller repull it, like get more recent stuff, or do you guys typically say, no, just give me whatever you had during origination and we'll pull on our side, repull on our side?
Yeah, I would say it's not common, because I think if you're requiring that, you're probably separating yourself from the competition out there, right? So the people that are selling are trying to obviously sell a batch of portfolio batch of transactions. Asking them to rerun is probably not economically viable for them. That being said, I would say, as you look at depending on the age of the portfolio. So if you're buying and selling at a pretty high frequency, and what you're selling is what you put on the books in the last month or two, there's probably not a need to probably rescore your portfolio.
Mm,
If you're buying and holding for a long period of time, 6, 9 months, where there could be material changes, it's probably not a bad idea to work with one of your data partners, whether it's Experian, TransUnion, Equifax, to refresh my personal credit scores on a soft pull basis, or PayNet, right, to refresh your PayNet scores, primarily just so you know what you've got on your book and you know what's sellable, right? There's nothing worse than a poor pull-through rate for both the buyer and the seller. It's a loss of efficiency and resources there. So if you're buying and holding for a period of time, I'd recommend doing some sort of refresh, so that you're not sending transactions that have deteriorated over to your funding partners. On the
great.
flip side, there's the other side of it though, is then if you have that, right, you should disclose that to your originators, your sellers. So just full disclosure there, if you've updated your scores, you should be providing that to your lenders as well.
Great.
And as a seller, if you're doing this on a blind basis, right, you probably don't want the lender to be pulling, or the buyer to be pulling even soft pulls, because then there's a hit on that obligor's personal credit report. So that's another reason that you might want to offer it to your buyer instead of having them do it themselves.
Mm. Got it. Well, we've got a couple of questions that came in. So we got Chris Lerma from AP. I think we all know him. He said, asked, are age contracts 12 plus months viewed more favorably? Is this taken into account when underwriting? Really good point. So if you've got an age contract, I assume they're making payments on time, everything's looking good. Or are you guys, are your scores reflecting that?
One thing that I've noticed over the past 3 years is that, let's see, PayNet and their inquiries and all that fun stuff kind of adversely affecting scores. So there is like a sweet spot in between origination and sale. If, in our case, 99% of the transactions that we originate, we're also adjudicating. So I guess it really depends on the sophistication of your scorecards and all that fun stuff. But for us, an aged contract is a little bit more work, because we need to get the pay history and make sure that we are up to date on that, and we're recording all of those entries. But for FinWise Bank, while we appreciate a good paying customer, we are going to adjudicate them individually at the time of purchase.
Yeah, I would say on our side, you really take it on transaction by transaction basis. So age contracts typically will play a bit more favor with the credit team on a couple fronts. If you may have had an asset that exceeded your app only limits, but now it's aged to a point where it's within your app only limits, that's a positive,
Oh,
right? It's no longer a full financial transaction. It could be an app only. On the flip side as well, you start to eliminate or reduce the risk for administrative delinquency that you might have on the first few months of a contract. So having a good paying customer, 12 plus months, definitely is helpful, right? You start to eliminate some of that potential early default risk there. So we do look at that a bit more favorably, having some age contracts. That being said, we love the early originations as well. But if you're talking more about the fence sitters, yeah, it definitely helps out, right? Because you've got aging, you've got experience with that obligor, so it will help out there.
yeah, great. Good question. Thanks, Chris. We got another one from Brian Donahue. If I was trying to read this, it's a little bit longer, but I think what the essence of his question is, how often are portfolios booked onto your guys's lease accounting system versus the seller continuing to service them? Like, do you guys, like, I guess Chris Morrell, do you guys allow or prefer the seller to continue to service, invoice, and collect on the portfolio, and or do you guys like to book it yourselves? Or do you do both?
Our preference, and there's a few kind of hurdles that we like to have our friends jump, but our preference, and as I mentioned, we have a smaller team and great partners. But our preference is to allow the originator to retain servicing, billing, collecting up to a certain point of delinquency. Typically, I think everyone on this call would agree it's 60 days. And then we like to pull it back in-house or sooner if there's any sort of material adverse change in the credit profile. So it is our preference to allow the user experience to continue to be optimal for the originator, right? We want to just be a good source of capital for that partner and let them retain a customer relationship. We will book everything into our accounting system and just we call it master servicing. So we just get cash from our originators throughout the month and apply it and run our GL that way. So that's our preference.
Okay.
If I'm reading the question correctly, though, I think the way the question is structured is wondering if I have 100 deals that I'm selling you, are you booking it as 100 deals or are you booking it as one deal and
Okay.
taking my reporting? So if that's the question, I've seen it both ways, right? There are certain lenders or buyers that, from an administrative standpoint, if they're not servicing it, they're booking it as
Book as
as
one
one
deal.
portfolio
Yeah.
purchase. We're booking it as that one deal. I'm not a huge fan of that because I've had to unwind some accounting processes while I'm doing system conversions and things of that nature where it gets really, really complicated and the reporting gets screwed up, specifically if it's on a perfect pay basis. But I do know there are some buyers that prefer it that way from just an administrative standpoint. Personally, not a big fan though.
Yeah, I think to Jordan's point, it depends on what the buyer's looking at. Are they buying a portfolio or are they buying a portfolio with multiple contracts underneath it? Yeah, I'm with Jordan. I mean, we book each individual contract because at the end of the day, that's what we need to perform. But yeah, to each their own, and obviously there's pluses and minuses on both sides for what you're doing.
And Chris, you book each one even if the seller continues to service them?
We do. Because for us, we really need to have consolidated reporting. And so we need to see what our entire book looks like, whether it's master serviced or if we're doing the servicing ourselves. So really we book them all at the contract level, and then we have a roll-up reporting that gives us a total portfolio view at the contract levels as well.
Great. Well, hey, let's take a look at the poll results. Laura, if you don't mind displaying those. So the poll was, and I'd love to hear your guys' thoughts on this, but when portfolio deals get bogged down, the most common cause is and missing information in the data tape needed to underwrite is number one. Would love to hear your guys' thoughts on that.
Yeah, no, I'll jump in real quick and going back to the NAICS codes and depending on your system and your requirements, right? So you need a unique identifier and you may need what your imports look like. NAICS code for us is one of them. And so, right, that can be a challenge. If we get a portfolio with no NAICS codes or SIC codes, that starts to hold us up because we need those to be able to get in our system. Yeah, the missing data is huge. Without the proper data, you can't actually get files in or adjudicate them.
We found issues on the equipment side, right? Like year, make, miles, sometimes like asset description. That's always a big one for us is specifically on used equipment, just getting any sort of hours or stuff like that. That's always fun.
Great.
Thing
What
I
was
would
number
add to
two?
that is
Yeah.
that there are other issues. There are ways to avoid that, right? And from an originator standpoint, I think best practices are once you've got a relationship, there are systemic processes or validation rules you can put in place to ensure that a deal can't get through to the approval to go on the seller's books unless all of these fields have been completed. And again, just the best practices, not onerous in most cases, especially if all the buyers are requiring the same thing. Garbage in, garbage out on the data.
Right, great point. I think you teed up David for a comment there. David, how can you use technology to do what Jordan just said?
It's a lot of process mapping, to be honest, and then building in the rules into your origination process. So it's figuring out what data you need to be super strict on up front, and then identifying the data sources that can provide the supplemental data, like maybe it's NAICS or industry or additional asset data. So things like Middesk, or getting additional data from PayNet about like the address and things like that. So you can still have a good borrower experience and not rely on your sales reps to manually populate this data by making sure that you get the core data needed to pull from other providers and then use that as a source of truth and sort of reconcile them together to create your overall picture. As far as like being in the data tape too, like, I mean, you can't really do anything with if it's missing. But if you're going to put every deal in your system, you can always think about following that similar process that you want the originator to, of if you have the full address, but you don't have NAICS, and you're going to put every deal in your system anyways to pre-qualify it or score it, using the data providers to provide that supplemental information or reconcile it against what the seller's providing you.
Yeah. We got another question that came in. I don't know if Chris Morel, you guys do large ticket. Are you Chris Model and Chris Morel? Are you guys all kind of app only on the buy side, or do you guys buy larger deals as well?
Our bread and butter is the app only business. We do have an appetite at the bank for full financial disclosure transactions. Without getting into a ton of detail, I think it really comes down to the partner that is originating the transaction and the expertise that they have, and the credit appetite that we have. Ours is a bank product once you get outside of the app only limit. Where we've had success is that bank exposure world, right? Whether it be buying a schedule or a few schedules, or participation, et cetera. So that's where we've seen success, is when we partner with banks that are keeping 20 million and selling off 10.
Okay, so more participations, because it came from Sherry Williams again, and I think like the essence of her question, I believe, Jordan will correct me if I misread it, is basically, does it require a full, like, what can the seller do if they're originating larger deals to make the underwriting, to facilitate the underwriting? Like, in other words, is it going to require like full adjudication and full underwriting on these larger ticket items? Or maybe you could, I don't know if anyone could speak to that. Jordan, sounds like you have some thoughts there.
I mean, my knee jerk, and I want to speak for those guys, but is that the purpose of a portfolio purchase from the buyer's standpoint is for efficiency, right? And should be from the seller's standpoint as well. If you're underwriting each deal individually, as you do with a full financial, you don't get that efficiency, because they're usually larger deals, they're bulkier deals, so on and so forth. So, I mean, maybe a pool just to amass a larger transaction to negotiate a better purchase price. But I don't believe that portfolio purchases are really aligned well with the concept that we're kind of discussing today.
Yeah, and I'll jump in there real quick. Agree 100% with Jordan. I think, to Sherry, to answer your question a bit there, some of it depends obviously on what the app only limits are at the institution that you're selling it to. As I mentioned before, on aging, you might have a full financial transaction that was larger that's now aged down to potentially an app only transaction. I think one of the other challenges, to Jordan's point, from an efficiency standpoint, comes from really the age of the financials you're dealing with, because if you're dealing with older financial statements, it's going to be a lot harder for an underwriter to get on board with a larger takedown with dated material, right? And so that back to Jordan's points, the efficiencies there, you start to lose that because then you're getting follow-up questions for updated financial statements. So if you're looking for efficiencies, it can be challenging. I think to Jordan's point, from a rate concession, you might be able to get some rate concession on a larger sale, but it's still going to typically require that full underwrite.
Great. Well, thanks, guys. And thank you, Sherry. So Laura, could you put up the next poll? So we'll get the next poll going and we'll start, we'll kind of move on to some other questions. So, God, I've got a bunch of questions left and not going to have enough time. So I'm going to start cherry picking a couple. So I got a bunch of yawns when I brought up vaulting last time. So I'm going to kind of skip the vaulting stuff. I don't know, maybe you guys want to talk just real quick. You should vault, don't vault. It's a waste of money. You have to do it. Just maybe a quick answer on that one, and we'll move on to more meaty topics.
Say, the guy with the gold makes the rules. What your buyer is requiring, you got to do. Leave it at that.
Okay.
Yeah,
I guess
we prefer vaulting, but yeah, it not vaulting brings a whole another set of challenges. So to Jordan's point, yeah, he who has the gold. So vault if you can, but there's definitely a cost.
Agreed.
Great. All right, we'll move on. Okay, David, want to start talking about pricing portfolios. So sounds like you've been on the lender side, and I know, here at Nortech, you've talked to a bunch of clients about how they price deals. How do buyers price portfolios?
I think without getting into anybody's secret sauce, there's two ways to think about it that we've sort of touched on, which is deal by deal pricing. So you're getting a portfolio and it's really, you're buying a whole bunch of individual contracts at once versus you're treating the portfolio as the instrument that you're buying. So there's different mechanics to those transactions that influence, what data you're going to provide to a buyer. So we talked about the traditional tape for the deal by deal pricing. I mean, it's typically going to be heavy demand up front to get that clean data on behalf of the seller to be able to get it into the system versus the portfolio, like as a security pricing methodology where you're looking more holistically at the lender and the pool that you're working with. It's typically only available for sellers that have been around a while and can actually prove out loss performance. At least in my experiences we've had to provide at the lenders I've worked with. And the data tape is a little bit lighter because they're just going to have some sort of recourse or yield enhancements baked into it that says, if this doesn't perform as a whole as what we expect it to, there's going to be some problems that you're going to have to address down the line. So it's, risk tolerance, who are you as a seller, that sort of dictates down what path you can go. I will say the approaches that the lenders who are really good at buying portfolios take is sort of like a little bit of each. So they'll look at the whole portfolio up front when they get the tape and do like an initial pass to see if it's decent or not, especially if it's a new seller, to kind of gauge what kind of deals they're going to be receiving from them long term. And then they'll follow their normal deal by deal process when they actually go to put the portfolio into their system and underwrite it.
Right. I don't know, Chris Morrell, does that kind of align with how FinWise does it?
Yeah, I mean, it definitely sounds like risk-based pricing, which is how we like to do it.
Yeah.
I think to David's point, and going back to what Jordan said before, efficiency. And I think if you're looking at portfolios, efficiency is the key word. And so from a pricing standpoint, you reward efficiency with better pricing through the portfolio process than you would on a one-off basis. And then the other points that David touched on, you layer in behind it, right? Whether it's credit quality, portfolio performance with yourself, those will all play factors into the overall pricing. But I think efficiency and data quality, data integrity, those really help drive the reasoning behind getting better rates than you would on a one-off basis.
Great. Okay, we've got question from Nicholas Moeller. Basically, I'll just read this one. So outside the internal tech that shows organized and efficient systems for originations, billings, monitoring, etc., and external use, data tape and data integrity, do you have any advice for new small ticket originators? Would it show strength if they first funded and then retained loans on their balance sheet for 12 months?
Hmm. We're all kind of thinking this one through, pondering a bit. It doesn't hurt, right? I think much like anything, I just use the word efficiency multiple times, and I'll go back to that. If you're not a good match for your buyer, right, then whether you're buying and holding is not going to matter. And sometimes for a new originator, the best way to figure out if you're a match for a buyer is to sell them one-off transactions, start to understand their credit appetite, start to understand their data requirements. You're taking a big risk, right? Because you're taking on the risk if you're buying and holding. And not to discourage it by any means, but it's not the silver bullet that just because you're buying and holding, now you're a great seller to buyers. I think it's kind of the combination of everything, but it doesn't hurt. But again, I think you want to make sure you have that efficiency and understanding on who you're selling to and what they're looking for.
Having been a small startup originator, I think one thing that we really regretted when we were selling paper early on and not holding it was getting that performance data back from the lenders that we sold to, so that we could say holistically, like, here's how this deal would have performed if we held it to term, so that when we wanted to go put deals on our books and sell season stuff and get better rates from the buyers that we were working with, we had that information available. So it's really about like overall performance versus like what you can do today and when to sell a transaction. Be my take on it.
Great. Hey, Laura, would you mind showing the results of poll number 2, please? Thank you. Okay, so which of these would most improve portfolio transactions? And so the number one answer there, well, actually, is consistent data tape formats across the industry. And interesting. So do you guys think that's due to, like, you're talking, Chris Monlin, about like manual entries and human errors when things are in different formats? I mean, is that why we'd see more improved portfolio transactions, or is there something else there?
I'm not sure, right? I think it'd be very difficult to have a singular tape across the industry, or because I think mine and Chris's are going to be different, similar, but different. How do we pick which is the right one, right? I think if I'm speaking from high up above, yeah, everybody should use my tape and it would be much better. But realistically, I know that's not possible. And so I don't think that's necessarily the key. I think the key is good data and making sure that you have a process for extracting your data in an efficient manner to provide to your sellers or your buyers, sorry. And I think that would be the key. It's just, having an efficient manner to access and get that data. Because again, when we sold our first portfolio, it was very painful, and I understood what our partners were going through. That being said, reps and repetition are going to help that out, right? The more portfolios you put together, the more you sell, you're going to find efficiencies and better processes, better tools to get those put together. So I don't know, I'm a little old. I just keep going back to data quality and accessibility there.
Yeah. It's interesting, like the 3 answers are all, I mean, the first answer is only 3 points above the other 2, and the other 2 at 29% are clear pricing expectations before underwriting starts. So that tells me that sometimes they're going to buyers and then just not getting the price they would expect and kind of wasting everybody's time. And the second one is better alignment between deals sent and buyer's credit criteria, which it seems like that's interesting too, because, when you go to the funding conference and whatever, you see, you guys are advertising your racks, right? You're telling kind of like what sort of criteria, but maybe you're casting a wider net than what you're actually taking. What's your thoughts on either of those?
I would
So
say,
go ahead, Chris.
For us, we're an open book. We'll literally hand someone, our credit guidelines, down to the the very smallest detail. And for us, I think, transparency is key. And so, that's where we found efficiencies, is just being, an open book with people and sharing what it is exactly that we want. And I think communication is always a challenge, but picking up the phone and calling people and talking through the first few portfolios and first few transactions, like Chris Maudlin mentioned, is very important to get a feel for folks.
Cool. Well, hey guys, there's so much more to dig into. We should have a part 2. So great conversation. It's top of the hour. People got to run to their next meeting. So Chris Maudlin, Chris Morrell, Jordan Segusa, David Trost, thank you so much for your time, and thank you audience for participating.
Thank you. You guys have a great day.
Thanks,
Thanks,
everybody.
Thank you. Bye-bye.